Okay, so we're going to talk about in this video the outlook for the Chinese currency, so the Renminbi, or specifically the USDCNY exchange rate, and where we see the risks from here. So this is from a recent report from a couple of weeks ago, and this is the report that I put out weekly, so you can see there's some other pretty interesting topics there. But if we go straight into number 4, this is China property plus USDCNY as the topic. And we'll go straight to the bottom line here. Devaluation risks are elevated for USDCNY, and we've got there in brackets trade war / politics, softer economic outlook, and policy rate differentials. So let's get straight into this and see what I mean. So first of all, I'm going to have a look at this China property plus USDCNY. So why did I mention China property? Well, if you look at the first chart here, China property price boom, you can see that there was a, pretty much a property price boom underway. You've got some pretty interesting clear cycles of boom and bust in the property market there. So there's a sort of short-term cycles. There was a pretty substantial slowdown in 14-15, but that was just turned right around. Pretty decisive mix of policy that boosted it then. But this rolling over is pretty key here, and this is shown this next one here. So the chart showing China property prices growth cooling. The red line is a composite leading indicator for the Chinese property market, and that's looking at things like M1 money supply growth, 10-year government bond yield, interest rate swaps, and also relative performance of property stocks. But the bottom line is it captures stuff that both reflects and fuels the housing market. And so the fact that it is pointing out, towards the end of this year as a more meaningful slowdown for China property market, that's pretty important, because if you think about the Chinese economy, well, actually if you think about any economy, the housing market is just so critical, but especially for China. Just so much economic activity flows off it, from construction to real estate, services, furniture, and it's a pretty key investment for them as well. With the capital controls, they're still pretty constrained on what they can invest in China. So property is kind of a natural go-to, and so if you have a bit of a slowdown there, then obviously it's going to impact on that through that channel as well. Then you look at the chart of export growth here, you can see whether it's rail freight volume growth or just a straight headline export number year on year. You can see they've rolled over. That lighter blue line there is the real effective exchange rate, and so that's been inverted, the year on year change. Basically, if that line's heading down, that means that the currency was strengthening year on year, and it was up until, I guess, the last month really. And so that headwind is basically coming through right now. It still works with a 6-month lead, so we're probably going to see a little bit more weakening of Chinese exports in the coming months, just on the back of that. But the other thing there, of course, is the looming political risk, or the trade war, tariffs. It's certainly not going to be helpful, particularly with that backdrop, and particularly seeing that it's already rolled over. So already we've got here, expectations of a cooling property market, and also, slower export growth. And I didn't show it here, but I showed it in the monthly chart book, the stimulus indicators. So I mentioned that there, talked about in the monthly chart book. If you want to have a look at the chart book, just let me know and I'll send you a copy. But the key chart there is a chart of stimulus, so fiscal stimulus and monetary stimulus. They've gone from major tailwind, though they helped me pick the rebound there, and to now a bit of increasingly headwind. So you've got the whole stimulus picture is turned around, and the political risk picture is worsening as well. Property slowdown, and that so back at the start when I talked about the downside risks for the CNY, the softer economic outlook, and definitely plays into that. But if you look at fairly traditional currency analysis chart here, if you look at the interest rate differentials, that gap is widening steadily as the Fed hikes rates, and the Fed's going to hike probably another 2 times this year, and that'll bring that differential further up in that direction, which again points to upside risk for the USDCNY. That's downside risk for the renminbi. Really, as I mentioned here in the title of this chart, policy rate differential makes renminbi devaluation the path of least resistance. And particularly so, if you look at that political backdrop, one lever that they've got to pull on if, they get a whole bunch of extra punitive tariffs is to just weaken the currency, make exports more competitive. And, if you think about, if their invoices are all in US dollars and, they get, say, a 5% tariff slapped on them, if the currency then goes ahead and weakens by 5%, then they're actually net no better or worse off. And if the currency actually weakened by 10%, say, versus a 5% tariff, then they'll actually be better off. So, it's definitely a lever that they can pull, and I wouldn't rule that out as a risk. And if you put that alongside the fact that just the pure economic arguments say that there's upside to or upside risk to the USDCNY. So I think it could easily head towards 7. 7 seems to be the line in the sand. That's where the devaluation wave that kicked off in 2015 stalled out. So I think well, there's again, it was a mixture of politics, but also critically economics, and that's what drives currency markets. And then the last couple of charts here just shows this resurgence of US dollar strength, which I don't think is going away anytime soon, is in the driver's seat. At least partly in the driver's seat there. And again here, the Fed already has the Hong Kong dollar sitting stuck at the top end of the peg range, which is quite interesting. It's it's much higher than it's been in the past decade, really. I think it's been quite a while since it's been up at that point. So again, it's another angle of the pressures that are building there. Now, the adroit observer would note that these charts, being a couple of weeks ago, are already out of date. So if we had a look at the where it's at now, so if you go back there, so it's already busted through that level, so that's sort of 6.65 level, and doesn't really show any signs of slowing down. And again, given that it's moved through that sort of, you can see a little bit of a resistance level around that 66, 65 level. I mean, again, 6.7 is probably going to be the psychological barrier to move higher, but it shows no signs of slowing down. And as I said, when you've got the path of least resistance due to the economics, due to the politics, and just due to rate differentials, monetary policy divergence, the risks are clearly tilted to more movement here. Again, I reckon it could easily head towards 7. I'm not sure if it will get beyond 7. That's going to be, the clear line in the sand at 7. If it moves beyond 7, then all bets are off, and that's going to, that's going to change the risk landscape very considerably. And if you think back to 2015 when we saw that devaluation, that one-off, well, it wasn't really a devaluation as such. It was just an adjustment. I don't think they realised what kind of impact that it could have had. But if you think back to that one, that triggered off a major global correction, and so far markets kind of been pretty much shrugging this off so far. I don't think that the market will continue to shrug this off if it heads higher. So anyway, that's I'll leave you with that last chart there, and if you have any questions, comments, put them in the YouTube comment section below. Otherwise, subscribe to the channel so you don't miss out on any future videos.